Hi, I'm Peter Rose, founder of Longwood Currency Trading. Forex price action danger zone decisions. What the heck is that all about? Well, look, what we're dealing with in talking about danger zone decisions is the position management phase of the life cycle of a currency position. If you're new to my channel, as a software engineer for 33 years, and one of the things that we followed in solving problems was what's called the software development life cycle, the SDLC. And so when looking at solving the problem of currency trading, when I got into it, I kind of did a rip on that and created what I have termed the life cycle of a currency position. And that solution process contains 3 problems that need to be solved. Each problem has one rule with 2 or 3 conditions to it that deal with the entire life cycle of a currency position, from entry analysis, position management, and exit methodology. So the your entry stop when you get popped out because you made the wrong, timed the entry the wrong way, and you get jacked on an entry stop, that's easy. You can set that as a static rule. But the danger zone of price action is much more difficult to deal with, and that's what I want to talk to you about in this video. Well, as you see, I'm in my kitchen again. I'm doing most of my videos in the kitchen because I love the kitchen. When we came here in 2017, this is early May of 2024, I saw the kitchen and I just thought, oh, this is such a great place. It's a 1775 antique cape in New Hampshire, in the Lakes region of New Hampshire. Just a beautiful house, an old house. And the kitchen just captivated me, and I just love doing videos in here because of the sun and everything. Today we have kind of an overcast day, as you can see. If you can see out the window, I haven't checked to see whether you can see out the window or not, but it's a little overcast, and we're going to probably get a few sprinkles later today or tomorrow. And just as an aside on another topic here, I had a comment on one of the videos I did, well, several days ago, several video releases ago, where I was outside and the barn was behind me. I mean, again, this is a 1775 antique cape and has this big barn on 2.7 acres of land. And some idiot, I'm sorry, but you're an idiot. You're trading currencies and you're a millionaire in real estate with this crappy looking barn behind you. I'm sorry, that barn was built in the 1800s. You don't want to touch that and make that a suburban style house. You want to leave stuff like that alone and appreciate what past people had to go through to survive in New England, and the types of structures that they needed to build in order to survive and to live and to have the fruitful and productive lives. So, yeah, it is an early 1800s barn, and that's just the way they look. So I'm sorry about that. Okay, back to our discussion of the Forex price action danger zone decisions. I'm going to put up a graphic here that shows where this danger zone is. As you can see from the graphic, it's really simple. I've got a place where I entered that particular trade. There's an X there, then a circle where the position is currently running, and then further up from that is going to be the exit point, the profit target. So that current position, where that is, that's in the position management phase of the life cycle of a currency position. So you have entry analysis, where you've either got past your entry stop or you haven't. In this case, you have. There are other conditions that determine where the separating line is between the entry analysis and the position management begin. I go over that in detail with the students, and we talk a lot about that because that's the core of the thing. If you have shitty entry theory, you're going to get popped out every time. You got to get a position into positive territory where you're 3 pips up or 5 pips up or something like that, there are some conditions that need to be satisfied before you can make the transition between entry analysis phase and the position management. But let's just wave our arms and say we're in position management where that current position is on that chart. And it looks like it's about halfway between where the entry was and where my potential profit target is. That has nothing to do with it. That's why I don't put up clean graphs or stuff, because people are going to be making connections like that. It's all rough because it's the principle that I teach. I don't teach stuff. I teach principles of trading. That's why it's more expensive to learn from me than it is from some fool that's teaching you what a Bollinger Band is. Some stupid shit. Okay, enough of the rant. That position, that price action has taken my position into some kind of an area where I would call that the position management area. Why is that the danger zone? That thing could turn around and go against you, and you could get stopped out if your stop is still there. If you didn't, maybe you lose 20, 30, 40 pips on the thing, and we're hoping it'll get back to where it was. And other issues that are around just a retracing price. You did your entry analysis, determined 2 things. This is where I'm going to get in. Well, 3 things. This is where I'm going to get in, this is where I'm going to get out, and this is where I'm trying to get to, that profit target, right? By taking that trade and putting your money on the line, you have a vested interest in the success of that trade. That's where your greed would tend to take place. And it's not. And I think that's why a lot of traders fail in their trading overall, because they're greedy when that trade is in profit and they're heading for that profit target, and all they're focused on is getting that profit target. That's a danger zone of decision, because you shouldn't be in a greed mode, you should be in a fear mode. There's a place where greed is appropriate to have, but it's not where that price is in that kind of la-la land between where your entry is and where your profit target rests. So what's the issue? The issue is a decision that if you don't know what you're doing, you wouldn't know how to codify that into a malleable rule, an extensible rule. I have such a rule, so I don't have to worry about it. But the decision process with a position that has gone past the entry and is in profit and moving toward the profit target is, and you know, if you're a day trader, your profit target is 15, 20, 30 pips, something like that. So let's say you're 8 pips up on a 20 pip profit target, or 9 pips up on a profit target. One lot, you're 90 bucks up, right? So that's a pretty, if you closed it out there and grabbed 100 bucks over your, well, in using metrics, you could say if I'm trading one full lot, I have $10,000 behind me. Now, the fact that you could trade one lot with $6,300 today, which is margin in the U.S., is irrelevant if you're trying to have overall risk management rules and the ability to create standardized metrics against your trading. You have to have some kind of a pattern, a plan for how those metrics are going to be developed so that they're standardized across hundreds, if not thousands, of your trades. So we'll just say $10,000 per one full lot. So if I divide $100 by the $10,000 that I have, quote, at risk, $6,300 of margin, and the rest is runway, I'm going to get a certain percent return against my bank. Now, you'd say, geez, I got $100, I got $90 there. That's not a really high percent. Well, yeah, what are you looking for? 20% return because you made 10 pips? You got to be careful of what you're doing here. And I'm not talking about 200 to 1 leverage or 500 to 1 leverage. I'm sorry, I should have said this up front. If you're watching this video and you're trading at 200 or 500 to 1 leverage, there is absolutely nothing that I will say in my videos that will be of interest to you, that you will believe in, or that you would do, so you would be wasting your time in watching my videos. Having said that, that $90 is a gain in your brain. Moving toward a 20 pip target, so you got 20 pips times 10 bucks, you got a pretty good win there, $200, or maybe you're going to 30 pips and you got a $300 win, whatever that is. But 90 bucks, that's 90 or $100. That's in your head as earned money, and it shouldn't be. You're greedy because you're saying, I got 90 bucks and I'm pushing toward that profit target. What you should be saying is, I got 90 bucks and I better fucking protect that. That $90 or that $100, let's say, well, if you made $1,000 profit against a $10,000 bank, you'd make 10%. So $100 is you're around a 1%, right? On a 10 pip move. So you're a little less than 1%. That's pretty good. Say, well, I don't want to take that because this is moving in my favor. Well, I'm going to go to 20 pips because that's where my profit target was. That's where I determined where my profit target was. So I'm going to let that thing, and I'm going to wait. I'm going to set and forget, and I'm going to let it go. Really. There are times when that's okay, but there are times, and those times must be considered as part of the conditions of the rule of your position management phase. Because what happens when that price turns around and drops from 9 pips ahead to 8 pips ahead? You drop 2 pips. You've lost 20 bucks of that 90. Now what do? You're greedy. So you're going to hold that. Drops another 2 pips. Yeah, you're 4 pips down now out of the 9. You're 5 pips into profit. So that $90 gain or $100 gain is now 50. It's half of that. Oh, but you're invested in that, so you're going to hang in there because, well, you could stop it at break or leave the stop where it was and take your original. They did your 5 and you got a 10 stop. You get a 15 pips before you would have been considered on a loser, and you're not going to lose more than the original loss that you had. So why not stick with it? I'll tell you why. At that point where you've got 5 pips left, that's a 0.5%. Let's say you let it slide to 3 pips up. You're at 0.3%. Now you could say, geez, I went through 3 pips of profit and on to 9 pips in 25 seconds. Why would I clip out at 3 pips profit? Well, you wouldn't. You'd let it go until the conditions of your position management rule indicated that you shouldn't let it go. Well, let's say you're stubborn. You have a rule, and it says this price action is not doing what my entry analysis indicated that it should do. And that should is stupid unless it's based on solid probabilistic analysis of your current price action, and that's all part of your entry analysis. And that's why you're so heavily invested in this particular trade. But you should be fearful enough that when it finally gets down to some, is it 0.5%? Is it 0.1%? Is it 0.3? I say it's 0.3% against $10,000 bank, $100,000 bank, $1 million bank, doesn't make any difference. Because if you could do, you say, my average win value, and these are part of your metrics. I'm a 60-40 trader with an average win value of 12 pips. Okay, so now you're thinking I got a 60% chance that my position is going to go to the profit target, which is not what that means. It means that you won. It doesn't necessarily mean that you got your profit target. But I have an average win value of this, and now it's down to here. How low am I willing to let that go so that I can retain a strong average win value? Let me tell you something. If your average win value was 0.3%, and you did that 3 days a week, you just traded 3 days a week, and you were able to get 0.3%. That's, well, 0.3 times 3 is 0.9. It's about 1%. So call it 1% a week. How tough is that to get 0.3%, 3 pips on a position that you've judged could go have the potential to go to 20, and you're so greedy that you're going to let it go to 20 and watch it go back through the entry level, and you don't have a stop to get out break because you're hopeful and greedy that it's going to turn around and go back toward your profit target and replace the 9 pips where you already were and go beyond that. So you're not going to bring your stop to break. You're going to let it go to 10, 20 pips, wherever it was, and you're going to lose $200 on the trade when you could have made 0.3%. And you do that 3 days a week. That's 1% a week. How many weeks are you going to trade in a year? There's 52. So that's a 52% return on your money. Let's just say you trade 40 weeks a year, and you can average out that. What are you making? Well, 1%, 50% on your money. You do it 40 weeks. It's 40% on your money. Where are you going to get 40% on your money? Oh no, you've been watching all these people out there. They're trading at 200 and 500 to 1, and they're jacking out and making 200, 300, 400% on their money. Yeah, but then turn around and look at them, and they lose their entire account because of that compounding that they're teaching you, and Bollinger Bands and all the rest of the stuff, and take your trade and set a stop, and then set your profit target and go do your shopping. Set your thing and forget it. That's a term that goes back. I've been looking at the financial markets since the mid-1970s, and set and forget is an investor's term, not a trader's term. And particularly in Forex, you're not a trader, you're a speculator. What the fuck are you trading? You're not trading anything. We're speculating. They're speculating on whether the price is going to go up or go down. The Forex price action danger zone decision that you are going to be faced with every time you take a trade that doesn't pop out at the entry stop is, how confident am I that that price is going to continue on and get to my profit target? And if it isn't continuing on, at what point do I want to close? Or am I going to be stupid about it and let it drop through? Who knows where you're going to let it drop through, because your greed will overpower your fear, and you cannot let that happen. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.